Both
right?
bonds and stocks down this year. I mean, everything stinks.
Yeah, look, and I think I'm starting to see the light at the end of the tunnel myself, Brian. I think, I've been out on the curve in terms of having a pessimistic outlook for this year. So I'm not surprised by both of those things necessarily. At the beginning of the year, and this is actually part of what gives me conviction that there's a light at the end of the tunnel. At the beginning of the year, recall that my target for the S&P 500 was 3,800. And I said that we would enter a recession this year. Both things were considered alarmist at the time. Obviously, that 3,800 is no longer alarmist. I've since revised down. I'm now looking at 3,300 to 3,400. And at the beginning of the year, the Wall Street Journal did a poll of economists asking how likely we would be to enter a recession this year. 18% said likely in January. They did that poll last month, 44%. So part of seeing the light at the end of the tunnel is coming to a shared reality of where we are and where we're going.
But I kind of teased, Greg, that maybe you thought there was some kind of a turn coming, or do you see more pain throughout the rest of the summer?
There's more pain to come, so don't get me wrong, but I see the turn after that. So the pain is going to be caused by the same thing the turn is going to be caused by. Recall that one of the things that I was really apprehensive about is that analyst estimates were way too high as we came into the second quarter. 20% of the S&P 500 actually forewarned that their analysts were too high, that their estimates were too high, and that they weren't going to meet them. So we are at the beginning of a pretty significant and meaningful downward revision cycle, which will keep pressure, keep a headwind on equity values as we go through it over the next 2 months. But once we get that behind us, that's behind us, and it's no longer a headwind. I believe that we're going to see peak Fed hawkishness this quarter. We'll likely get this month. We'll likely get another 75 bips, and I believe it will trail off from there. That will be behind us. We'll likely get some downward draft on valuation. And once that's also behind us, we get to actually do the work and figure out, well, what's a good bargain from here and what does the forward trajectory look like? And so pain to come, but the light at the end of the tunnel is there.
Okay, well, that is some good news. Listen, and I hear you. You've been out there warning about these markets, Greg, for a while, and people say, oh, fear-mongering, whatever. We've been talking about this European energy crunch since last year. We were in London in the fall, sort of talking about this. I'm probably going back soon. This, to me, and I know I'm talking my own sort of editorial book because I've been hammering this story. Right. It's a giant, it's not just an energy story, it's an economic story. It's a market story, is it not?
I do believe both things that you're saying are true, Brian. Number one, it is probably more important than we've come to understand or take it as. And number two, it's certainly under-discussed. And the weaponization of energy in Europe, partly the weaponization, partly, obviously, we have strikes in Norway and some in Germany that are going to cause spikes in the commodity prices as well as the transit of them and the availability has decreased. But what the domino that I'm really concerned about that's after that is what happens to some of these sovereign debt positions. What happens with Greece at 193% debt to GDP, with Italy at 150%, with Portugal at 127%? These are levels that are far above what Greece experienced during the 2008 Greek debt crisis. And we've had so much else going on that the possibility of a sovereign default, or at least severe sovereign stress, particularly with the ECB no longer a net buyer, with central banks around the world tightening and shrinking their balance sheets, it does warrant being on the radar.